Ladies and gentlemen, good day and welcome to HLE Glascoat Limited Q4 and FY22 earnings conference call. As a reminder, all participant lines will be in listen-only mode. There will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Rasika Sawant from Orient Capital. Thank you, and over to you, ma'am.
Good evening, everyone. I'm Rasika Sawant from Orient Capital. We are an investor relations advisor to the company. Today on this call, we have Mr. Himanshu Patel, Managing Director of HLE Glascoat Limited, along with the senior management team. Before we begin this call, I would like to give a short disclaimer. This call may contain some of the forward-looking statements, which are completely based upon our beliefs, opinions, and expectations. As of today, these statements are not a guarantee of our future performance and involve unforeseen risks and uncertainties. With this, I hand over the call to Mr. Himanshu Patel for opening remarks. Over to you, sir.
Good evening and warm welcome to all the participants. Thank you for joining us today to discuss HLE Glascoat's Q4 and FY22 financial performance. I hope you and your families are healthy and safe. I pray for their well-being. Today on the call, I am joined by Mr. Alap Patel, Executive Director, Mr. Harsh Patel, Director, Mr. Naveen Kandapal, CFO, and Mr. Nilesh Ganjwala, Senior Advisor to the company, and our investor relations partner, Orient Capital. I hope everyone has had an opportunity to go through our financial results and the investor presentation, which have been uploaded on the stock exchange as well as on the company's website. The Indian economy witnessed a positive momentum in the fourth quarter of FY22, and this is also reflected in our strong order book for both filtration and drying equipment and glass-lined equipment business. This reflects the continued robust demand from the user industries. During the quarter and year ended March 2022, all of our plants were working at high capacity utilization. The robust order book combined with increased production capacities is expected to result in stronger dispatches and sales in the coming quarters. This is a testimony of our team's effort of delivering performance despite the tough external environment. In continuation to our strategy, we are introducing improved products and technologies to all players in the end user industry, particularly in the MSME sector, has a tremendous potential, and the management team is focused on adding newer customers from this segment. We also plan to expand the geographies with a renewed thrust on exports for both our key product segments in the coming quarters. This will make our business model more resilient operationally as we diversify our customer base. The company is developing unmatched execution capabilities, and the same needs to be strengthened further. Hence, we are growing our professional team to execute the company's vision and growth strategy. We have strengthened our executive team by making senior level hires in the operations and support functions. We are pleased to announce the completion of the CapEx programs at our Moroli and Silvassa plants. We spent approximately rupees 15 crores at our Moroli plant by adding new manufacturing sheds, which will augment floor area by about 40% for manufacturing of filtration and drying equipment. Further, we spent another approximately rupees 50 crores at the Greenfield Silvassa plant, which will further increase manufacturing capacities for the filtration and drying equipment. With these developments, the company is well poised to reap benefits higher production in the coming quarters, given that the capex has already been incurred. Lastly, As you are informed, the Thalitech acquisition was successfully completed after receiving all the necessary regulatory approvals. Now we are working on various integration initiatives and identifying synergistic opportunities. The company will look to cross-sell existing and new product ranges to both HLE as well as Thalitech's domestic and global customers. With this acquisition being completed, the company is in a position to augment its consolidated revenues and profits whilst also reaping the benefits of multiple synergies and complementary capabilities of the two companies. Our commitment to client retention, satisfaction and other sales service remains unchanged. We continue to implement our long-term product capacity and market expansion strategy. I would now hand over the call to Mr. Naveen Kandpal, CFO, who will brief you on the financial highlights for the period. Thank you, and over to Naveen.
Thank you, Himanshu, and good evening to all the participants. I hope that all of you have had the opportunity to go through our results and investor presentation. With respect to the financial year 2022, our overall consolidated revenues were around rupees 652 crores, which means a growth of 35%. EBITDA stood at somewhere around 118 crores, again a very good growth of 23%, and PAT stood at rupees 8 crores, a growth of 9% over the last financial year, 2021. 49% of the revenues came through filtration, drying and other equipment segment, while the remaining revenues came from the glass line equipment segment. Both these divisions have showed robust revenue growth. 30% growth we witnessed in our filtration, drying and other equipment, and around 65% growth came through glass line equipment. EBIT growth for filtration, drying and other equipment is 5%, whereas EBIT growth for glass line equipment is 69% over the last financial year. With respect to the last quarter of the financial year 2022, our revenues were rupees 249 crores, a growth of 59%. EBITDA stood at rupees 40 crores, a growth of 37%, and PAT was at rupees 23 crores, a growth of 30% over the same period last year. While revenues from filtration, drying and other equipments have grown by 47% to rupees 104 crores, revenues from glass line equipment increased to rupees 143 crores with a growth of 114%. EBIT for filtration, drying and other equipment stood at rupees 15 crores, registering a growth of 11%, and EBIT for glass line equipment division grew by 47% to rupees 22 crores. So these were the brief highlights. Now I would request the moderator to open the floor for questions and answers. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Kaushal Shah from Dhanki Securities. Please go ahead.
Yeah, thank you, sir, for the opportunity and congratulations on a good set of numbers. Sir, I have a few questions on the demand environment and also on the company. So, in this particular environment, we have, like many other companies, we have seen a little deterioration in our working capital. I think that has been explained in the presentation also. But some thoughts on how do we see the working capital moving from now, and when do we expect it to normalize going forward? given that prices at least in some of the commodities have started correcting. So that was the first question.
Thank you for your question. The working capital environment has changed, as I think we had mentioned probably in an earlier conversation or on the call as well. This is a temporary situation that we have seen ever since the start of the COVID disruption. We are seeing some hesitation on the part of the customers to pay as much in advance as we used to earlier. This is, as we believe, it's a temporary situation and which will ease out over a period of time. The current disruption on account of the change in metal demand and supply situation, which is our main raw material, has led to us taking a slightly more conservative stance and building up a little bit higher level of inventory, and probably a little higher working capital is on account of the higher amount of raw material that we hold, as well as the value itself of the raw material which has gone up. So yes, we do see this happening currently, but as I said, this is expected to be temporary and should normalize maybe over the next few months.
Right. So prices, as we speak, have started correcting in terms of several commodities, including steel. So would you expect that towards the second half of the year we would be in a position to have maybe similar working capital numbers or in terms of days that we had earlier?
I think your point is very valid. Yes, prices have started correcting, but we don't know at what stage this price correction will stop. So yes, if the prices come back to older levels, then I believe our working capital cycle will also be at similar levels as we were earlier.
Right. Nilesh, a few questions on Thaletech. We've seen fairly good numbers from the German company in fourth quarter. For the full year, how do you expect that to move? The order book, as you've mentioned in the presentation, continues to be very healthy. So how do we see the top line and also the bottom line in terms of EBITDA margins moving up? We've already seen some improvement in the fourth quarter, but given that the order book is already there, there is also a possibility of some cost savings, etc. So where would you expect margins over the next, let's say, 1 year or 2 years in Thaletech to move? Like I said, not just in the current year, but over the next 2 years or so.
So if you look at Thaletech, I think it's a classical example of how we've been able to build efficiencies on top of a good established infrastructure. In December 2020, Thaletech's operating or EBITDA margins were in single digits. We saw that improve towards the end of calendar year 2021. And of course, the last quarter has shown a further improvement. We believe that these are fairly realistic and sustainable operating margins, subject of course to external environment, but we believe that these are sustainable. In terms of the overall outlook on the business, I would like to request Alabhai to maybe elaborate on that.
Hello, good evening.
Yeah, hi, Alabhai.
On the overall outlook of the German entity Thaletech GmbH, I think generally the market still is positive in Europe. Order inquiries have not slowed down. Order book is also, as you might observe, only grown compared to the December figure. So overall market sentiment is still positive. Yes, there have been some disruptions in the supply of raw materials, some disruptions in terms of energy, etc. But that has, even during the peak of the problem, which is when the Russia-Ukraine war started, order finalizations have not stopped. Fortunately, the disruption in supply of raw materials was fairly short-lived, and even availability of raw material today is not a problem.
Okay. So, given that it is a European entity, what kind of number, would you be looking at in terms of top line growth? I mean, we have seen, at least in the past, they've grown in double digits. So this kind of a top line growth, in your opinion, can be maintained, or it can be even be increased?
Yeah, I think we believe we should have double-digit growth going forward. And of course, the effort is to not just look at pure growth in terms of pure numbers, but also to build maybe over the next year or two on the synergies between the two entities and the two geographies. And we believe that it is not just about growth in top line, but we are also working on building on other elements which will make this a very great synergistic play.
Right. Will it be possible for you to share the volume numbers for HLE as well as Thalatic for the year?
When you say volume numbers, I'm sorry, I didn't understand the question. If you
So
could,
in terms of units for both glass-lined as well as for traditional dry, would it be possible for us to share the volume numbers for both the entities?
So I think the glass-lined numbers for the year would be in excess of 2,000 equipments for the year. That is from the Indian glass-lined equipment business. The filtration and drying numbers would be in close to about 600 for the year. 600 equipment for the year. That's the number.
And Thalatic?
Thalatic would be closer to about 400 for the last completed financial year, which is calendar year 2021.
Sure. Also, Himanshu Bhai in his opening remarks mentioned about hiring people at senior level. So if you can maybe throw some more light, and are we expecting a possibility of higher employee expenses over the next 2 to 3 years?
See, the hiring at the highest level is obvious because as we are growing, we need very professional people with us. So hiring will continue for the coming years. And I hope that the numbers will, the people will help us add numbers or add growths to the company.
Right. So one final question before I join back in the queue. Your outlook on the demand scenario, since we are catering to spec chem, chemicals, agrochem, etc. How do you see the demand unfolding? There has been an obvious price pressure for virtually all industries. So your thoughts on the demand? How do you see the next let's say 2 quarters, 4 quarters, and maybe any discussions that you've had with your clients as to how they see their demand and therefore the ordering activity. So some thoughts on that, sir.
So I think that's the area where we see the same level of both momentum and confidence. The inquiry pipeline is as strong as ever, especially over the last 3 years, and continues to be so. Over the last quarter also, actual order bookings have shown no signs of slackening whatsoever. So that is a good situation. We are seeing a stray case here and there of some delay in order booking simply because somebody in that company doesn't want to look out of place with the amount of volatility in the market. But other than that, no, we don't see. I think the pipeline and the order book continues to be as robust as ever.
Thank you. Thank you, sir.
Thank you. A reminder to participants, if you wish to ask any questions, please enter star and 1. The next question is from the line of Mithun Mehta from Lucky Investment. Please go ahead.
Yeah. Good evening to the entire board. Good evening, Nilesh Bhai, Alap Bhai, and everybody. My question is particularly in the glass line equipment business. And in the standalone business, I'm not talking about Thale, because Thale we have done wonderfully well despite difficult external conditions. But in the domestic business, if we look at Q3 standalone number and Q4 standalone number, between Q3 and Q4, what has changed that has led to fall in EBIT margin for the glass-lined equipment business? Well, I do understand that the material prices was a big cause of concern, but sir, if you could just highlight as to what are some of the changes that you see on the ground which led to drop in margins, and do you feel that we can come back to our original margins as we move into Q1 and Q2? Also, if you can highlight the similar concern on the filtration and drying business. Well, I do understand that Q3 was an absolute bottom sort of a margin quarter for us in the segmental result, and Q4 we have improved by about 100 basis points. But we are still sort of much below what we used to earlier drive our F&D business. And that business where we continue to remain market leaders, and we have significantly improved our capabilities in F&D business. So there also, if you can indicatively give us some guidance as to where we are headed as far as margins are concerned. So these are my two questions, if you can highlight.
So I will take your question on the F&D part first. On the F&D part, as you yourself noted, we had a drop in margins in Q3, which was due to the impact of the higher raw material prices flowing into the numbers at that point of time. Actually, the same impact that has now flowed into the numbers of the glass-lined reactor business or the glass-lined equipment business. So we're basically seeing a drop in margins predominantly due to higher raw material prices. As we suggested earlier, we believe that this is transitory. As the matter goes up, as the matter goes back to normal, we should go back to our regular margins going forward. Why we've been, again, an interesting point here is that even though we've been able to pass on the increase in the cost to the customers, it is obviously not possible to pass on the margin on the increase of the cost. And hence, from a pure mathematical perspective, the percentage in terms of margins are a little lower compared to the previous quarter. There is also a marginal impact of gas prices going up because, as we had indicated earlier, some of our furnaces, not all, luckily, but some of our furnaces are gas-fired, and the cost of operations of those gas-fired furnaces have marginally moved up. So that has also been a marginal impact on the overall cost of production.
Well, as far as the power and fuel bill goes, I don't see any material change in the variation in the fuel prices. That has remained more or less stagnant at 5.5 to 6 crores. Of course, I do believe that the material cost has been a big worry. So, as things stand today, have we been able to pass on the material cost to our end customer, or are the new inquiries or new contracts coming at a fairly higher price so that we come back to our original margins as early as possible?
Yeah, the answer to both your questions is yes. We are able to pass on even in the past, we've been able to pass on the cost of the material increase. What we've not been able to pass on, as I said, was the margin on top of the material cost. So let's say my material cost is, let's say, at around between 45 or 50%. If my material cost goes up by 100, I cannot increase my prices by 200. Our price increase will pretty much be equivalent to the cost of increase of the material. So hence, as a percentage, margins will take a hit.
So is it fair to assume that the margins that we reported in glass-lined business, there the mean reversion will start kicking in from Q1 onwards?
Sorry, if you can you repeat that question? Sorry,
yeah,
I didn't get
it. So the margins that we saw in glass-lined business in standalone India in Q4, do we believe that these margins were like absolute bottom and the margins will start looking up as we go into quarter 1 and quarter 2, given the fact that the steel prices have come off by 10 to 15%?
I really wish that what you say is right, but honestly, we hope so too. But as we've seen in the past, a lot of times we make any predictive assessment of the future ends up being wrong. But at least the trends appear to be in that direction, yes.
And sir, Nilesh bhai, also one other question that I wanted to ask you is that, this year, because of higher steel prices and because of the strategic reason of stocking more inventory to fulfill the order requirement, our working capital has gone up, and so therefore our debt has also gone up. Going into FY23, do you believe that we should be able to retire some part of debt that we are currently holding as on 31st March 2022?
Actually, if you look at, to answer your question on the debt increase, in fact, the substantial amount of debt increase is linked to the investments that we made during the year, not on the working capital. Actually, the increase in working capital has very largely been financed from operating profits. So operating profits have been plowed back into working capital. In terms of the investments, as you are aware, we did an expansion of the capacities at the glass-lined unit at Anand. We also expanded the facility at Maroli, which is for the filtration and drying equipment. And we also set up a greenfield project in Silvassa, which was also funded partially by. On top of this, in December, we also completed the acquisition of the 100% equity of Thalitech, which was also partially funded by debt. So actually the increase in debt is more related to the investments in capacity and the acquisition than in working capital.
Since we are at our bulk of the capex or large part of the capex is now more or less completed, and both Maroli and Silvassa have started producing, this year should be a year when we will see cash flow, and therefore we should be able to retire debt. So is that the right assumption?
I think that's a logical way to look at it, because we completed our capex program, as Himanshu bhai stated earlier. We also completed the acquisition. Obviously, the impact of these investments in the profit and loss accounts will reflect in this year. And obviously, these kind of capexes are not required to be repeated for obvious reasons. And hence, these capacity increases will flow down to better liquidity and obviously leading to debt reduction. Yes.
Do you have any particular number in your mind that you would like to retire debt from the present?
We would be happy if we can bring this debt down by half, but that's only I would say a wish at this stage. Yeah.
By half. And sir, as far as your glass line capacity is concerned, are we more or less maxed out, or we can still grow our output by another 20-25%?
In terms of current capacities, it may be possible to enhance production to some extent, yes. But the campus itself at Anand gives us scope for some more expansion in the coming couple of years, yes. So we have scope to expand, as well as we have some scope for enhancing production given the current capacity.
So how much, by let's say 15-20%, you can enhance your production from the current capacity?
So using current capacity infrastructure, I would say enhancement of about 10 to 15% may be possible. We are currently operating at close to 80%.
Okay. So does that mean that you will have to finalize an expansion on the glass line very soon?
We'll again have to look at how the disruptions in the market play out, whether it will happen in 6 months or it will happen in 2 years, honestly, very, very difficult to say.
Okay. Great, sir. Thank you very much.
Thank you. A reminder to participants, if you wish to ask any questions, please enter star and 1. The next question is from the line of Jason Soans from Ashika Stock Broking. Please go ahead.
Yeah, hello, sir. Thank you for taking my question. Actually, so just to begin with, I just had a sort of a question. In terms of manufacturing process, sir, your major competitor, GMM Pfaudler, and just wanted to know, in terms of a manufacturing process, is there something different between? So I understand GMM Pfaudler is a trademark product, glass steel is a trademark product, right? So in terms of a manufacturing process for GLE, is there a significant difference between the manufacturing process? Because where I'm coming from is, my question comes from, in terms of that you both hold a lion's share in the domestic market. So how difficult is it for the competition to replicate, this model? Just wanted to understand, in terms of manufacturing process, is there a marked difference between your process for Pfaudler and your company?
Right. Let me take that question.
Yeah.
So while I cannot make a lot of comments on my competitor's manufacturing process, I would say, generally speaking, manufacturing process for a glass-lined reactor is pretty standard. Where the difference in the quality is created from is the nuances of the process. So glass lining being a highly technical process, I think process control, understanding of each and every operation that is done to finally manufacture the product, and then establishing a good enough control on every step of that process determines the quality of the end product. And I think what we believe is that our expertise, again, which has been demonstrated quite clearly even in our filter dryer business, our expertise is to establish process control in a job shop environment, in a manufacturing environment. And we also believe that there has to be continuous improvement in how you manufacture your product. So the process that I'm following today need not be the process that I follow tomorrow. And to answer your question, I think our edge is in finding that last bit of continuous improvement and to keep finding that year after year. And that's what sets us apart rather than the process that any of our competitors may follow.
I think I would like to add a little bit to the question that you asked. So what I would add is that glass lining is part science, part art. Also, in addition, what happens is this is more of a performance product. This is not a product which is sold on specification. So you can't say that this dimensions and it is a glass line reactor. You can't say that this thickness or this color. So what happens is the quality of the product is proven only in the field. And the fact that we have so many installations and for over many years also kind of determines who stays in the market and who does not. So the entry for a new player is difficult because number one, he has to first get the track record right, which usually is very difficult. And second, the product performance is known only after a few years in service or a few months in service at least, if not years. So in that sense, the entry barrier is quite high because at least the good customers do not really take risks because that would affect them their entire production.
Okay, sure, sir. Thank you for that. And also my next question is what I want to understand is, so you have acquired Thaletic, and even Pfaudler, that side also has acquired the global business of Pfaudler International. So my question comes from this aspect that, when you look at pharma manufacturing or chemicals manufacturing, there is a lot of focus and shift from the west to the east. So manufacturing is coming to India and to the east for various reasons such as cost, majorly being cost and other things as well. China plus one, etc. is going on. So manufacturing is actually shifting out of from these high cost locations such as the US and the Europe. US and Europe. So I just wanted to understand, in terms of doing global acquisition, how does that play out? Because it doesn't it make more sense to focus on the Indian centric business and have a more Indian centric play rather than focus and acquire businesses globally.
Let me.
Yeah.
Okay. So what I will tell you, my understanding of the situation is slightly different. See, what has happened during COVID is that a lot of things which were global, being sourced from China, India, Indonesia, were done during COVID. A lot of countries realized that certain things, certain critical chemicals / products have to be made closer to home. So while you are right that a lot of manufacturing is shifting from West to India, but now after COVID, what has happened is a lot of countries, for example, Germany, a lot of chemicals which they never thought they would make ever in their life, they are putting up their plants. So the China plus one strategy has intensified, but now also China plus one means China plus your home country. It does not necessarily mean India or so-called low-cost country. So while most low-tech products are coming to India, but some of the high-tech products which had shifted to China are actually shifting back to the home country. So in this scenario, it makes real sense to be present locally because number one, for example, it is very hard to sell an Indian product to a German chemical company because of various reasons, including servicing, reach, etc. It is much easier, even if more expensive, to sell a German product to a German company or a European product to a European company. So the China plus one strategy is playing out in two ways. China plus one means India as well as the home country. A good example is chip manufacturing. So, for example, who would have imagined that semiconductors would now be made in India and Europe or the US? So that's what is also happening in the chemical sector. That kind of trend.
Sure, sir, and definitely you can leverage the Indian entity as well, in terms of, as a more cost-effective base and export it abroad as well. That also will help you aid realizations as well, isn't it?
Yes, of course. That is always an option. That is something we will always look at. So that is never out of the table.
Sure, sir. And just wanted to know, regarding this Russia-Ukraine crisis, just wanted to know any impact on the European demand, in terms of GLE or F&D. Have you seen any impact on the ground level in terms of overall demand environment?
No, I think we have not seen any substantial impact on the demand. Both the demand and the order book continue to be strong. And I think even at the peak of this problem, we were still finalizing orders with our customers, and in many cases, some customers were, generous enough to also consider an open delivery date depending on the availability of raw materials. So I think demand continues to be strong. Support from the customers continues to be strong, and I think there is a general understanding of the realities of the market, and there is, like I said, there is great support from the customers.
Okay, sure. And sir, just about your F&D market. Now, in terms of your major competitor, so Mavag, basically, it's a Swiss subsidiary. They do say that they have a strong focus on the high-end spectrum of F&D. So, in terms of high-end specialized F&D equipment, which will kind of yield better margins. Now, I just wanted to know what is your strategy in this aspect of for exports, for F&D especially. So, what is your strategy in? Hello. Can you hear me?
Yeah, we can hear you.
Yeah, we can hear you.
Yeah. So let me just repeat what I was saying is, for Mavag, which is a subsidiary, they do talk about focusing on the high-end spectrum of F&D equipment, especially for overseas clients for Europe and US. So I just wanted to know so you are a domestic market leader in F&D. So in that sense, what is your strategy towards the export market, towards the high-end F&D equipment?
As far as the F&D equipment is concerned, I think it's relatively clear that HLE has always been a leader of sorts, both in terms of number of equipment as well as the innovation in design. So we are active in the export markets, but as currently the domestic market demand is so high, we are unable to export more than what we currently are doing. Having said that, we currently have installations and we also have ongoing orders from most of the developed markets of the world. So we are currently selling in the US, Western Europe, and so on. So we do not believe that quality or technology will be a barrier to our growth in the export markets.
Okay.
In fact, Nilesh, I would just like to add to that, to say that the original inventors or pioneers of our flagship product, which is the Nush filter, they are currently acting as our distributors in the European and American market.
Okay. Sure.
Thank you.
Okay. Thank you. That's all from me.
Sure. Thank you. The next question is from the line of Jaivir Shekhawat from Ambit Capital. Please go ahead.
Sure. Thanks for taking my question. So firstly, on the Thaletic acquisition itself, so wanted to understand what has driven the 7 percentage point increase in the EBITDA margins over, say, 2018 to 21. Your thoughts on that?
So there have been considerable changes in multiple aspects of the way the business is run. There have been changes in the operations layout and the operating framework of the company. There have also been changes in the cost structure that they have implemented by way of some element of automation and so on. And hence, we are seeing that improvement. There's also a consistent, continual improvement in or innovation that this company has shown over the last 2 to 3 years. So they've come up with multiple innovations, which is enabling them to not only get a better market demand, but also getting a premium pricing. So even the pricing of their products is far superior than what it used to be about 3 years back due to the innovations that they have brought about in the product. So that's the reason why Thaletic has shown a considerable improvement in the operating margins.
Sure. So just to understand, it's largely coming via the pricing front. Anything on the cost front that might have been done by the predecessors that might have helped improvement in margins? Because that's a substantial portion of margins that have increased.
Not really. As I said, I think the substantial improvement is actually being driven by innovation, not so much by just operating efficiency.
And would you have any sense in terms of
some improvement in operating leverage due to, again, growth in top line? But that is not on account of any other, let's say, operational differentiation.
Sure. You mentioned that the aftermarket revenues constituted roughly 40% currently of the overall revenues. Any sense on where they were probably in 2018?
So they've consistently been in excess of 35%. So again, that constitution or the breakup of the sales or revenue mix has not really changed dramatically, no.
Certainly. Okay. And your thoughts on what the integration as well as value sourcing could do in terms of improvement in the EBITDA from here on? I think one of the participants had asked on this front, but wanted more clarity on that.
So on the integration front, I think obviously there are several synergies that will come into play, and as you very rightly pointed out, value sourcing is one of them. There is an opportunity to. So I would say this with a qualifying statement. I think Thaletic's inherent strength in the market, or rather one of their important value propositions has been a made in Germany product. And I think that has been able to propel them to the position of a market leader, and they have been able to retain that position with continuous innovation and a made in Germany product. So for us, the idea is not to manufacture the entire product in a low-cost market like India, but the idea is to source strategic raw materials or sub-components or sub-assemblies from a cost-efficient market such as India, and we have ample capacities here at home to make that possible. So
sure.
Yes, value sourcing will happen, but not in the form of an entire product in India.
Sure. And lastly, if I may add another question here, given that Thalatic revenues are almost about 1/6 of the overall revenues of the Pfaudler International, wanted to understand from you your strategies in terms of increasing the market share going forward. And will the growth for Thalatic have to be, say, sacrifice of revenues for Pfaudler? Or is the market big enough in order to accommodate both the players at the same time?
So I think right now Thalatic is very much focused on Germany and the German-speaking parts of Europe. So a large amount of revenue comes from these two markets. The operations of Thalatic are not entirely global in nature. There is also some revenue that comes from the United States, and some portion of the sale comes from other parts of Europe and some parts of East Asia. But predominantly the sales are generated from Germany and the German-speaking parts of Europe. So in that sense, this still leaves a huge opportunity for Thalatic to capture these markets and grow its top line.
Sure. Thanks a lot for answering my question.
Thank you.
Sure. Thank you.
The next question is from the line of Gokul Maheshwari from Africa Capital. Please go ahead.
Yeah, thank you for the opportunity. You mentioned about the sort of the broader outlook on the European business in terms of double-digit growth rate. On the domestic business, in terms of where we are in terms of the cycle and the demand environment, could you comment on the broader growth rate for next 3 to 4 years? I'm not talking from a quarterly perspective, but more from a broader direction of how you see business growth for the next 3 to 4 years.
So I think we have over the last 5 years or so demonstrated CAGR in excess of about 23-24%. We believe that kind of growth in excess of 20% for the next 3 years it looks feasible at this point of time.
Okay, that's great. And secondly, in terms of once you are achieving such kind of growth rates, does economies of scale help you improve your profitability, notwithstanding the challenges of short term with respect to material prices? But again, once these are a bit normalized, do you think that margins can or your operating profits can grow faster than your top line?
So I think operating leverage actually works when we increase production or increase production capacity at an existing campus. So whenever we have done capacity expansions at our existing plants in Anand and Moroli, we have seen operating leverage kick in, and I think that's reflected in the numbers already. However, whenever we set up a new greenfield campus, as becomes necessary at some point of time, and like we've done now at Silvassa, the increased production capacity at Silvassa, while it will add to the top line and the bottom line, may not actually see operating leverage until we go in for some additional capacity expansion, maybe sometime in the future. So I would say the operating leverage coming from a pure increase in top line, yes, that's something that we've already seen. But at the operating level, in terms of manufacturing costs and number of people and labor and so on, that is actually also dependent on capacities and utilizations at existing plants and not necessarily when we set up a greenfield project like we've recently done at Silvassa.
Okay. And just on your ability to leverage your positioning in Germany now with this acquisition, you Would it be fair to say that you will be able to leverage both India and Germany in such a manner that you can significantly improve the profitability of the German acquisition by taking out manufacturing more in India but designing more in Germany, whereby increasing the profitability in German operation?
So I think value sourcing, as Alap just mentioned, is definitely one of the elements of the strategy going forward. The other elements would include a improvement of knowledge and sharing of knowledge, because both the Indian entity as well as the German entity are focused on development and innovation, and there is lots to learn for both the teams from each other, and that is a process that we've already kickstarted. We believe that that is really the driver of substantial synergies and margin improvements going forward. So what we really want to achieve is to achieve a better product both in India and from Germany, as well as have higher capacity utilizations by way of improved production methodologies. So these are both elements that are part of our integration strategy.
Great. This is really helpful. Thank you and all the best.
Thanks. Thank you very much.
Thanks.
Thank you. The next question is from the line of Milind Muchalla from Julius Baer. Please go ahead. Milind, your line has been unmuted. Please proceed with your question.
Yeah, am I audible now?
Yes.
Yeah, thank you for the opportunity and good evening to everyone. Just had a few questions. So first question was on the GLE business in the standalone operations. So can we get some perspective in terms of what was the volume growth over there? Because if I just look at the revenue growth, which was around 12%, and I would typically presume that that is the kind of price increases that would have happened over there. So any perspective over there?
So yes, you are right that the volume growth is marginal. The volume growth was in the range of 2 to 3%. This is also given the fact that we were already operating at very high levels of capacity utilization even at the end of the last financial year. And for the substantial part of this financial year, we had the same capacities installed. The commissioning of the expansion at Anand only happened in Q3 of the financial year, and the actual output from that expansion will probably start getting reflected in the coming quarters.
So will that reflect in Q1 numbers, you're saying? It wasn't there in Q4 and it will start getting reflected in Q1, you're saying that?
That's correct. Given that the production cycle itself is ranging from between 3 to 6 months, yes, that's correct.
Right. And what is the capacity expansion that we have taken in GLE? Around 25%?
Roughly about 20%.
20%. Okay. And again, so if I were to just look at the profitability of this business, the GLE business, so again, on an absolute basis, there has been a fall. So from, say, 15 crore EBIT, we are down to 11.5 crore. So what led to that decline in profitability on absolute level?
So, in terms of absolute levels in the quarter 4, as we said, the raw material cost has been slightly higher as a percentage of the total sales. Even at an absolute level, it has been higher because some of the orders that we had said, I think we had probably stated in an earlier call as well. Some of the orders, because we had an open order when we do our quotation, we quote with a validity of over 30 days. And in the Q1 and Q2 of this financial year, we had seen substantial volatility in metal prices. Some of the orders were taken, although the metal prices in the interim moment had moved a bit. But considering our commitment, we have not only taken those orders but also executed them. So yes, it has hit us marginally on the bottom line.
So now going forward, where would you put this figure in the sense, where do you think the EBIT margin can kind of stabilize for both the businesses, GLE as well as F&D for the standalone operations?
So we, in a normal situation, and definition of a normal situation where we do not have the kind of volatility that we have seen in the last 4 or 5 quarters. If we don't see this kind of volatility in the raw material prices, we believe we can go back to a normal EBITDA margin in excess of 17 to 18% across both businesses.
Okay, great. And second question was on this Teletech operation. So basically, how is the gas price scenario right now, and are we kind of well positioned to pass on this entire gas price increase to customers?
Okay. In Germany, all our main furnaces for the glass lining business are electric fired and not gas fired. So the impact of gas on our business and margins is very, very minuscule.
Okay. So it's entirely electric based. There is no
just to
gas.
elaborate, we were just using 1 or 2 small furnaces for components, so there could be a very, very marginal impact due to that. But it's really not really worth switching off.
Okay, get it. And this expansion of capacity for F&D. So in totality, what will be the percentage expansion that will materialize for us?
We are expecting a total capacity expansion of about between Maroli and Silvassa put together in excess of 50%.
Okay. And for this Silvassa facility, so I got your point in terms of it may not be margin accretive, but will the margins be similar to our existing margins?
Yes, our operating costs are expected to be similar since we are incorporating the same manufacturing SOPs and manufacturing procedures, yes.
Okay. And just one question on this F&D business. So basically, if I were to just look at the differential between Concall numbers and standalone numbers for F&D, so there again the profitability is lower vis-a-vis the standalone levels. So I would have presumed that if this is the export business that is there, then the margins could have been slightly better. So can you just kind of give a clearer perspective over here?
Could you just elaborate on that, please? I'm sorry, I didn't get your question entirely.
Sure. So if I were to just kind of deduct the standalone revenues of F&D from the Concall revenues, so the revenue works out to around 23.5 CR, on which the EBIT works out to 2.7 CR, so which gets converted to an EBIT margin of 11.7%. So just the differential between Concall revenue and standalone revenue.
No, so that revenue is actually related to the production at the Silvassa partnership firm, which is also a subsidiary of the company.
Oh,
we have this company called HLE Equipment, which is a partnership firm where HLE Glascoat owns 99% ownership. So that is the consolidation impact of the partnership firm.
Oh, okay. So why are the margins lower over there?
So margins are not actually lower, actually because most of the margin is already incorporated in the standalone numbers by way of a line item which is called a share of profit for the firm. So it reflects in other income and hence the margins are not lower. Actually, they are just repeated.
Oh, okay. Get it.
So it's only a pre-tax, post-tax impact that is getting reflected.
Right.
This is due to the application of the accounting standards in normal course.
Right. And in terms of, so I know this question was kind of answered, but again for GLE, so again this 20% expansion that we are looking at, and hopefully the way the overall business momentum is building up, so that kind of lead us to again reaching the optimum utilization pretty soon. So then what are the thoughts over there in terms of expansion of capacities?
Yeah. So I think what we have followed so far is always a stepwise expansion in the form of debottlenecking. So if you see for the last nearly 5 years, so beginning 2018, every year we have made an expansion. So we already can identify what section of the plant is likely to be a bottleneck coming up, and as and when that bottleneck comes up, we, in a plan or in an advanced manner, we make an expansion. So I think our last expansion that we made was for components. The one before that we made was for assembly, and the one before that we made was for glass lining, and the one before that was for fabrication. So I think we have always approached this in a phased manner, and we will continue to make phased expansions as and when required.
Okay. So when you spoke about a 20% aspirational revenue growth that we are looking at, so I would presume it would be for GLE as well. Would that be a right reading?
Yes, we are looking at a 20% growth across both segments of this.
Okay. And just one last one.
I would also like to add is that output increase doesn't just come from capacity increase. There is also always a continuous improvement effort that goes on in our manufacturing plant. So the growth in output is not always directly proportional to expansion of capacity. So better utilization of furnaces, which are our resource, better utilization of assembly infrastructure, so assembly pit, for example, also can very much result into a higher output.
Okay. Great. Thanks a lot, everyone, and all the very best.
Thank you very much.
Thank you. As there are no further questions from the participants, I now hand the conference over to Mr. Himanshu Patel for closing comments.
Thank you very much for actively participating in the session, and I wish you all a very good evening, and I wind up and thank you very much.
Thank you very much. On behalf of HLE Glascoat Limited, that concludes for joining us, and you may now disconnect your lines.